while you're still in, a lot of times you're in the best shape of your life. You're young, you feel invincible, you can take on the world. You're not even thinking of a time when you might need care or you might need someone to take care of you.
Long-term care wasn't something I was thinking of. I was 29. I was at the epitome of my health. I felt like I could rule and rock anything that I wanted to. I felt invincible. So long-term care was not in my head.
Well, I come from a military family. My father served in the Marine Corps. In fact, he served for about 30 years in the Marine Corps. And I grew up understanding the importance of serving God, freedom, and country, and he instilled that in us. Looking back on my retirement, there's a lot of great lessons learned I had. And I'd like to share that with men and women who are considering leaving the military, whether you're retiring or whether you're just going to be separating. One of the most important things to do is start planning out your exit from the military.
One of the things that I found as I went through this process is that I didn't even know what long-term care was, let alone long-term care insurance, and what would cover it and what doesn't cover it. A lot of people think that the VA will automatically cover it, which it does in some cases. Oftentimes, people think that your health insurance, like TRICARE, for example, will cover it, or, oh, I'm on TRICARE for life. But it doesn't. It doesn't cover the long-term care needs. It certainly covers your health needs, your acute care, things like that. But when it comes to nursing home, assisted living facility, in-home care, it doesn't cover what you think it covers.
So that phrase, hindsight is 20/20, is so real in this instance for me. Even though I was at a time in my life where you don't think about being anything but invincible, step outside of your I am superwoman zone and realize that one day, as you look at your mother, as you look at your grandmother, that's real, that evolution of life is coming at you. It will come to you. So if you can prepare for it in advance, in any way, it really benefits you to do that.
And then when you find out, okay, this is going to be covered as far as health care, very important to start looking into long-term care, something we don't really think about, particularly when in the military, until we get out. Long-term care is extremely important.
If you plan early with something like the Federal Long-Term Care Insurance Program, that moment in time, the little bit amount of time and preparation it takes to apply and enroll can pay huge dividends later on for you and your family.
So I strongly recommend that you look into the Federal Long-Term Care Insurance Program, because you will eventually get great benefit from it by pursuing it now.
One of the important things to understand is that a long-term care need can arise at any time, whether it's from health-related issues or from an accident. So it's important to prepare ahead of time, because when you're in that event, it's stressful enough in and of itself. So if you have a protection in place, then that's one less stress, one less thing you have to worry about.
Okay, do we have everybody? Wonderful technical folks. We got Peter. So let me go ahead and we'll go ahead and get started with Peter in a second. And that video we just saw was actually a video from my good friend, Colonel Retired Hunt Kerrigan, who represents Long-Term Care Partners. And he is one of the wonderful folks on the panel today. And I see Matthew Doyle from Penn Fed Credit Union. Looks like he's coming on. Hopefully we'll see Hunt in a second, but Hunt wanted to run that video you just watched before he addressed us. So why don't we go ahead and get started with Mr. Radvani, who is a registered investment advisor and a wealth manager. And Peter, impart your wisdom on us. Oh,
good afternoon, everyone.
Yeah, and by the way, Peter, just not to interrupt you, but folks, same deal applies as when we heard from the Chief of Staff of the Army. If you have a question from one of our panelists, please type it into the Q&A, and we'll make sure we ask the panelists later after they do their initial presentations. I'm sorry, Peter. Go ahead.
Good afternoon. Can you hear me, Jack? Because my computer's saying my microphone's not on.
We can hear you. I can hear you.
Okay, perfect. I just want to make sure. Well, good afternoon, everyone. My name is Peter Advani. As Jack said, I'm an investment advisor, and I also manage the Warrant Officers Lifetime Members Fund. It's been a crazy year with COVID and everything else going on, but I'm happy to report that the Warrant Officers Association Lifetime Members Fund is doing well. It's positive for the year, and despite everything that's been going on, everything is looking good. So I'd be happy to answer any questions.
Okay, well, let me go ahead and introduce Mr. Matthew Doyle. Matthew, can you hear me?
Yes, I can. Can you hear me?
Yes, we can hear you fine. That's great. I'll tell you, it's a whole new thing for us here doing this virtual thing. But Matthew Doyle is, I believe, a financial planner from our wonderful partners at PenFed Credit Union, who we've been partners with for 3 decades. And he's been good enough to join us to talk to us a little bit about the personal financial planning and you know, maybe how some of the products that PenFed offers us at a discount might actually fit into a financial plan. So Matthew, take it away.
Well, first off, thanks for having me here today, and I'm honored to be here. My role at PenFed Wealth Management is program leader. So we have a team of financial advisors that cover all 48 states, Puerto Rico, Guam, and Okinawa, Puerto Rico, and all over the world. So I was asked today to come talk about something fun, and we always want to make sure we're giving back to our membership. So what we want to talk about today is the top 8 personal financial tips going into 2021. And you know, unless you've been living under a rock, we know that COVID has been a big financial event for so many of our members, and will continue to be going into the next few years, likely. And really only in the coming years will we identify exactly what the effects really are on most folks' personal finance. So I'm sure Peter can talk better than I can about things like investment management, and we have experts in my team. But my focus is behavioral management when it comes to personal finance and consumer finance. So today we're going to talk something fun. We'll go the top 8 personal finance tips going into 21. Again, this is consumer finance, not small business. This is average person that we deal with. What are the best things that you can do for your finances going into 2021? So as we discuss these, just think about what we call marginal gains. So these are the small and little transactions in your finances that help you improve over time. There's really no magic bullet out there to get you that $1 million boat that you want overnight, but it's a series of small transactions over your lifetime, working with a trusted financial partner and saving diligently over the years and investing intelligently that'll help get you where you want to go. So let's get this started. Here's the fun part. So the first one we talk about is, as it's October 21st. Of course, what's happening in the next 3 months is holidays. So the first one we want to talk about is avoiding holiday debt. So a lot of our members share with us over the years that they tend to run up balances on their credit cards over the holiday season. They tend to not create a budget. So the good news is now, since we're talking today, October 21st, is you've got lots of time to create a holiday budget. And I want to share with you, just paint you a picture of what the most successful budgets look like as we see them. And they are simply a spreadsheet with everybody's name that you're purchasing for, everybody down to your kids' teachers, to the folks that you work with, to the folks in your family. It doesn't matter what religion you are or what you celebrate, but if you're going to be giving holiday gifts, what you need is a simple Excel spreadsheet, person's name, what you want to get them, and their budget, and you need to stick with it. So that's the first thing you could do, is to pay yourself first going into 2021 by avoiding that holiday debt. And it's easier than ever to run up holiday debt, easier than you think of, where most folks are working remotely or at home, or you have the temptation of things like Amazon in front of you. The free 2-day shipping is wonderful. It's very easy to quickly whip out that credit card, or even in Amazon's case, just have it permanently plugged in and really start to run up some debts very quickly. So our second great personal financial tip going into 2021 is we're going to talk about finally cutting the cord. Now, if you're a Comcast customer like me, or depending on who your provider is throughout the company, you may have special feelings for your cable company, and special, like, unpleasant special feelings for your cable company. You may have a $250 bill a month. You may have hundreds of dollars in fees every year that you're paying for things that, hey, just not getting the most bang for your buck anymore. And how many of us really watch a whole lot of live TV? And you're normally at this time of year, I'm watching live football and live sports, but beyond that, how much live TV do you really watch? And versus how much versus in that $13 Netflix bill are you watching? So my first piece of advice to you is call your cable company and complain about your bill. Most cable companies are willing to work with their customers to help folks not only stay on board, but perhaps if you're not going to be a cable client anymore, at least so they can sell you a good internet package. But the first step is call your cable company and complain. Think about those equipment rental costs. You've got 2 or 3 TVs in your house. Maybe that's about $9 a month per piece in equipment. $27 a month times 12 months really adds up when you add fees, taxes, and federal expenses on top of that. So think about cutting that cord, those incremental gains for 2021. The next one I want to draw your attention to is the retirement plan auto increase tool. And the way this works is for those folks who have 401ks or 403bs, or you're part of the TSP plan, your plan likely has a feature that you can painlessly ratchet up your contributions annually. And what that means is you can set a particular date like June 1st of 2021, and the plan will automatically continue your contributions, but actually raise that. And so you may be able to raise it in 1%, 2%, or whatever it may be. And a lot of folks time that with their annual COLA date, which is the cost of living adjustment date, and that will help you pay yourself first. And the reason I mention, why wouldn't you use this tool, or, why would he mention this, is that for most folks that we come across, making that adjustment annually, no one will do it. I should say really no one, but most folks won't do it consistently. If you set it automatically, you pay yourself first, and you don't have to have that painful conversation with yourself about logging in and increasing that contribution, because you can't borrow for retirement. The next tip number 4 for 2021, is start taking your privacy and online security seriously. And this one seems like an dull one, but I'll share with you as a PenFed employee and a longtime credit union employee, way too many of our clients have the password, that's PASSWORD, or password 123. I'd be shocked at how many folks have that. Set automatic notifications for transactions. So if wherever your bank account may be, if you have Bank of America, Chase, PenFed, whatever it may be, those organizations all offer transaction notices. That would be, for example, a foreign transaction on your debit or credit card. Send you an email. Significant balance changes, large checks or deposit. Get those automatic notifications set up, and you can typically do them via email or text. That'll really give you power to know what's going on in your accounts. And help those around you to be safe too. Guys, if you're on this call, what's a major problem in the US these days in financial is elder abuse. So help your kids and your spouse and elderly parents avoid scammers by changing their password, and make sure they understand that no one's going to be calling them from an 800 number asking for their password and username for their accounts. So it's a very important thing. Take that privacy and online security seriously. So number 5, let's talk about the CARES Act. So we know what the CARES Act was. That was a significant multi-trillion-dollar relief package for the virus that was passed earlier this year in the first quarter. Just a couple of highlights there. If you took advantage of the mortgage benefits and you took advantage of the forbearance, your benefits may likely be ending soon. So if you say took advantage of it in March, April, we're now 6 months out, 180 days out, your mortgage benefits may be ending soon. And depending on how you set it up with your lender, you may either have a balloon payment, or you may simply have your payments resuming shortly. And if you haven't planned for that, that may be a shock for you. So be aware of that. Student loans. One of the things I want to point to is if you had federally backed student loans that were available or eligible as part of the CARES Act benefits, in that your payments were due and interest stopped accruing on your account. A lot of folks didn't pay attention that their auto debit bill stopped. I'm sorry, these slides are advancing here. The auto debit bill just simply stopped. So for a lot of folks, they simply stopped making their student loan payments, your kids, or if you're making them on their behalf. Be advised those student loan payments are likely to begin after December 31st. So get ready for that. Be ready for it. Tax filing, a couple of hot tips here. So as you remember last year, the tax filing date was extended to July of 2020. The 2021 likely file date is going to be April. It's going to feel funny. It's only 9 months apart when you may have filed previously. So be aware it may feel strange. Get ready for that. The standard deduction increased from 2019 returns, so it's good to know. And there's been some nice updates with charitable deduction changes for 2020. So take a look at those, especially if you're a person who may give cash to charitable organizations. There's some nice changes with that. And for those folks that are on here that are over the age for required minimum distributions, that was waived. That was previously a taxable event. You or your parents may have had mandatory minimum distributions in the past, and they didn't happen in 2020. So just be aware of that also. A couple more tips. First one, this is a no-brainer, increase your credit score. So you may see on TV lots of different folks that seem like shysters or used car salesmen telling you about how to increase your score quickly. I'm here to tell you there's really no magic bullet, but here's the easiest ways to move your credit score forward. First is to pull your score and your full report quarterly and pay attention to the on-time payment history and any missed payments. And what that means is when you pull your full report, it should include all of your payment history for your credit accounts. And if you made a credit card payment a few months back and it wasn't accurately applied and it's not reflected on your credit report, you want to make sure you're there checking that out. Also look for anything that doesn't belong to you. We find a lot of our members have things on their credit reports when they apply for a credit with PenFed, liens, public records, medical items, charge-off, a T-Mobile account that they never had, all sorts of things on there, so be aware of those. We also recommend getting a credit monitoring services. There's a whole bunch of different options out there. LifeLock is an okay one, but LifeLock doesn't include your full credit report. So I would recommend a credit monitoring service that not only does monitoring, but it includes your credit report too. So you want to make sure you get both for your money. And the last one is to resolve to have more money unity with your partner. Make sure your partner has all the same information that you do. And what that means is have better conversations by focusing on facts and goals and less about emotional sticky points that get people upset. And what that means is we've seen from our membership that the folks that have the best money harmony with their spouse work like a business. They present the state of the business with just facts and figures. They run it like a business and they work towards their goals, taking the emotion out of it by making a balance sheet for your household. You can have a balance sheet and a cash income statement. Sounds like complex things, but it's money in, money out every month. You can use an Excel spreadsheet. You can use a notepad, whatever works for you. But presenting that to your partner as a business will allow you to be most successful in 2021. So this has been Matt Doyle with PenFed Wealth. I'll be here. I want to thank you so much for having me today. And PenFed is proud to support the Warrant Officers Association for over 30 years. Again, thank you so much for having me, and I appreciate it.
Hey, Matthew, thank you so much for that. Great advice. And is my good friend Colonel Kerrigan on the line?
Jack, can you hear me from New Hampshire?
We can hear you from New
Good.
Hampshire, Hunt. And
Good.
I'll tell you, we watched your wonderful video. And folks, if you watched the video before we got started with Peter and Matt, that was Hunt at the beginning of the video.
Yeah. Well, thank you, Jack. I just wanted to say hello to everybody from beautiful New Hampshire. You know, I was stationed in Alaska for many years with the Alaska Guard and then moved to New Hampshire, and boy, is it ever beautiful here. Again, my name is Hunt Kerrigan, and I retired after 32 years in the service. Jack and I had the opportunity of serving together in 1999 for General Davis, the former chief of the Guard Bureau. It was great. So I worked part-time for a fantastic company called FedPoint, which administers the federal long-term care insurance program, and I'll talk a little bit about that in a few minutes. But I work full-time as a military spouse. My wife serves in the Maryland Air National Guard, and I have two young boys, an 11-year-old and 8-year-old future guardsmen, so I'm kind of full-time dad duty and really enjoying it. So I'm honored to be here among all of you. This morning, my civilian boss asked me, so what's a warrant officer? And I suddenly had to flash back to 1984 in Kitzingen, West Germany, when I was a young cavalry scout with the 3rd ID. The warrant officers ran the supply for the Bradleys and M1s, and I remember you never messed with warrant officers. And that's helped me throughout my entire career. So I responded to her, warrant officers are professionals with amazing amount of experience and great respect. So again, I'm very excited to be here today and very honored. I'm here to tell you just a little bit about long-term care insurance. I'm certainly not an expert in the field. In fact, I'm filling in for someone who has much more experience, but I volunteered to speak to you because I just wanted to share a quick story with you and also just keeping an eye on the time. So my mother-in-law may soon need long-term care insurance, and we, the Kerrigan family, are not prepared, especially as we're raising two young boys. Most service members my age have got the kids outside of the house. We're still raising two boys. So when I was on AGR in Alaska about 10 years ago, I could have had my mother-in-law apply for long-term care insurance. Let me repeat that, if I had known about it. So while you're on active duty or in the Guard, parents and parents-in-laws and step-parents of active duty are eligible to apply. Again, if I'd known about that 10 years ago, if someone had come up to me and said, hey, you might want to consider getting long-term care insurance for your in-laws, I would have probably done it. So there is two amazing websites that gives a lot of information about long-term care. One is benefits, benefeds.com, and then another great website, ltcfeds.com. And they have tons of webinars. They give great G2, really good intelligence about the whole program. And again, I'll be around to answer any questions on this. And before I get off, since I have this opportunity to talk to a lot of individuals who are going to be retiring soon, having retired 5 years ago, I just want to give you three things that I think are very, very important for someone who has done this transition. And let me tell you, the transitioning is harrowing. It's not necessarily easy. It's frightening at times. In fact, I know a one-star general who retired, and he said that retiring is climbing up Pointe du Hoc on D-Day, and the Germans are shooting down at you. It's extremely difficult, so be prepared. So three pieces of advice I'd like to pass on since I have your attention. One is absolutely start networking a year out. Start networking a year out. Two, and this might have already been mentioned by Matthew and Peter, have at least 6 months of savings. It's going to take you that long to find a rewarding post-military career. 6 months of savings. And then finally, and Jack, I'm almost done here, finally, find a fantastic veteran services officer, one who's accessible, one who's knowledgeable, and one who takes the time to talk to you, and take your VA disability seriously. It's huge. I just met a Navy SEAL a little while ago who's been retired for 5 years, and he's never put any VA paperwork in. So those are the three things I wanted to pass on, especially the VSO. Take the VA disability rating seriously. Do not blow it off. My email is hkerrigan, KERRIGAN, at fedpointusa.com. Jack's got it. And that's just some of the things I wanted to share. Thank you very much, gentlemen. Ladies and gentlemen, thank you.
I wasn't turned on. Sorry about that. Thank you, Hunt. And one thing I wanted to stress that I mentioned earlier when I was thanking our corporate partners is that the federal long-term care insurance program is just that. It's actually a benefit. It's a service that you can buy into, like SGLI or something like that. That is available to you, and it's a discounted program over what you're going to get in the private sector. So that's why we wanted to make sure everybody understood it. And FedPoint also manages as I mentioned earlier, the new FedVIP program, which is replaced not only your dental, but for the first time provided a vision plan for uniformed services retirees. So really want to thank Hunt. And we do have a few questions from folks. Let's see what we should do first. So one question is, let's see. Great question from Gary. And Gary asks, and this is for you, Hunt, we are starting to see serious health degradations for some people that have tested positive for COVID. Where do you see this fitting in with long-term care? And I guess this might be, an eligibility question. Do you want to take a stab at that, or is that something that maybe we need to provide an article in our magazine in the future on?
Yeah, I think in light of the enormity of that situation, and what I'll do is I will get back in touch with that individual about that.
Okay, good. And get back to me, and we'll definitely get back to Gary. I know Gary, and I know
Great.
where to find him. And maybe, like I said, maybe that's a great question. That's a question that maybe is a corporate partner spotlight article in a future magazine. Maybe we could start in January. Not to put the arm on you in front of 250 people, Hunt.
No, it's fine. No problem at all.
But and just as a follow-up to that, Hunt, before we move on, because we have a couple other questions for the other panelists. Sure. Here's another question that someone asked, and they said, so I'm eligible for LTC insurance. How about my family, and when should I consider buying it? And he probably heard you talking about your mother-in-law. So could you just address that again real quick?
Well, again, we're talking about eligibility. Is that individual a retiree? If he's currently serving, he can get his parents and in-laws. They can apply. But if he's a retiree, then it's just simply for himself and his spouse. Great question, though. Okay,
great. Thank you very much, sir. And so we have another question. Basically, Michael asks, and this is to you, Peter, what should members be investing in personally? I guess, Peter, could you talk to us a little bit about the investment horizon that you see awaiting us, and maybe what the asset allocation strategy might be? And then maybe I'll ask Matthew to chime in when you're done too.
Sure, absolutely. Yeah. Depending on how much money you have, if you're talking about your TSP, I would say the stocks look the best too. If you're talking stocks and bonds, I like stocks, equities, more than anything right now. And that has to do with where interest rates are, where interest rates might be going in the future. I think they have more room to go up than down, rather. I think the Fed has sort of boxed itself in terms of being able to navigate downwards. So I'd be very careful with putting too much of my portfolio into fixed investments like bonds, bond funds, and things like that. I love equities. I love stocks. I like the long-term outlook of the U.S. economy versus Europe right now versus Asia. I would stay away from Europe and Asia. I would definitely overweight U.S. equities versus foreign equities right now, especially in the European and the Asian sectors. Although Japan is doing well, if we're talking the TSP, the C fund is where I would overweight, and I would go ahead and put some money into the S fund as well. I would lighten up on if that's part of your allocation. So that's where I see things. Now, if you're an individual stock investor, that's a different story. You've got to look at what's been beat up the most. You just have to be careful with things that are beat up. Are they going to come back? Are they going to stay down? I think a lot of questions remain about whether or not the airlines are going to get bailed out. I assume they will. I don't think you can allow the airline sector to go under, and I think the government will bail them out. Cruise lines is a different story because those cruise ships, they're not technically U.S. corporations. They're registered offshore and abroad. So the U.S. government is going to bail out Norwegian cruise lines, for example. So just be careful about where you invest, and don't get too aggressive. Don't gamble too much, and just have a long-term view always in place. I always look at investing as a long-term thing. It's never a short-term thing. We're going to have drop-offs in the market like we had this past March every once in a while. This was a black swan event, if you want to call it that. But we always have drop-offs every few years in the market, whether it's a 10 or a 15% drop-off or whatever. So, that's par for the course with investing, and just take advantage of those opportunities. Look at what's cheap, reallocate your portfolio from time to time, and just take advantage of what the market gives you.
Hey,
that would be my advice.
Right, Peter, thanks. And I think that that's, that's good advice. I mean, we all know interest rates really can't get any lower. I would think, part of your advice probably also, and I think I heard you maybe mention it, is look for values and look for income producing things that can replace fixed income requirements. And I also heard you mention it's a long-term strategy. And I think maybe as I move to Matthew, uh, I think what Peter says makes a lot of sense. If you're not a sophisticated investor, maybe you go with a life cycle strategy just because you're not sophisticated enough. Maybe you don't have somebody like Peter helping you out. But as maybe you could address, short-term investment horizons as part of a budget and maybe an expectation that you're retiring or something like that, and how you might, approach investing approach that question from Michael from the standpoint of a financial planner, maybe somebody who's getting ready to retire.
Sure, I agree with a lot of what Peter said. I think that if the original question is what should members be investing in personally, whoever you're working with, whether you're doing it yourself or you're going to choose to work with a partner, the most important thing is that party understands you and your time horizon. What someone my age, 40 plus, would invest in versus my parents in their 70s would invest in are two very different things. So it's important to have an outlook with that. I think it's important to also understand in the next few months, there's going to be a ton of volatility based upon the presidential election. And then we just need to be comfortable with the unknown. Like Peter, I'm also bullish on US stocks. And my expectation would be if there's a significant dip, I'm buying in, just being bullish long-term about US equities. As mentioned too, you mentioned the Lifecycle Fund. That is a great choice for a lot of investors, and there are literally hundreds of billions of dollars in the U.S. economy invested in them, especially through a lot of folks' retirement plans through work. And just for the folks that are on the line that don't know what a life cycle strategy is, it's a single mutual fund that invests in stocks, bonds, and cash equivalents for folks to invest in. And what it does is based upon your projected retirement date or the projected date that you'll need the capital back. It invests in it. It's kind of a one-stop shop strategy for life cycle funds, depending on the company. Fidelity happens to call them life cycle, but there's a bunch of other different companies. T. Rowe Price has them, a huge portfolio of them, American funds. But it's a single mutual fund that you can put all your money into. And the way it works is if for myself, if my target retirement date was say 2035, I would invest in the Life Cycle 2035 fund, all my capital. And it would be managed that it would become less and less risky over time with a stocks and bonds mix that would change and be managed for me. So the money would be available theoretically, ready to go at 2035. So yes, Jack, you echo what Peter said. I'm absolutely bullish about the future of the US markets. But I will always caution anybody to get ready for some volatility coming ahead. And there's money that can be made in volatile times for disciplined and patient investors who are continuing to enter the market and not shying away with the ups and downs.
No, that's great advice. And, I would suspect that, you need to find someone like either you or Peter to give you advice. And, I know they set up these life cycle funds specifically with people in mind who, maybe don't have somebody like Peter or somebody like you to advise them on a continual basis. And so that's great. But if you can, and Peter, comment a little bit on the life cycle funds toward the end. I mean, it seems to me like right now, if I was in a life cycle fund and I was at the, maybe in a, because they do them by year from what I understand. They do like maybe a 2020, 2055. And then, in 2020, you're predominantly invested in the stuff that, the assets that Peter was talking about, which are good now, which is equities and things of that nature, income producing value equities. But then as you get closer, like you said, it shifts toward more conservative investments. But I'd be interested. To me, it's kind of a weird time. I mean, like Peter said, interest rates aren't going to go any lower. I mean, Peter, what would you add to what Matthew said about that?
Yeah, so the life cycle funds, the theory behind those is the older you get or the closer you get to retirement, the more conservative you get, meaning the greater percentage of your portfolio is invested in bonds versus stocks. You know, I don't want to give specific advice to anybody because I know I'm talking to a broad audience, and some might be retiring sooner versus later. Um, I think Matt brought up a great point or you brought up a great point as well, is, you know, find someone that you know, that you like, and that you trust, and sit down with that person and tell that person your life story. Tell them who you are, because everybody's different. Everybody has a unique situation, and then work together with that advisor to formulate a plan that works for you, because financial planning is not a one size fits all type of thing. Everybody's different. Everybody has their unique risk tolerances and circumstances. Everybody has a different amount of money. Everybody will need a different amount of money in retirement. Everybody's different, so you can't really generalize a lot of things. But to answer your question, with the target date funds, the closer you get to retirement, the older you get, the more conservative they become, quote unquote conservative, meaning more of your portfolio is invested in bonds. And with where interest rates are right now, I'm not a big fan of bonds. However, they may or may not be right for you. You know, the traditional approach has always been, you know, you have 60% of your portfolio in stocks, 40% in bonds, maybe 70-30 when you're younger, maybe 50-50 when you're older, or even more conservative, meaning leaning more towards bonds. But I think the last 10 or 15 years has sort of taken that traditional model and turned it on its ear. Whereas if you've been invested in bonds, you've missed out on some tremendous gains. And you also have to take a look at what kind of bonds you're invested in. I think a lot of these bonds they're in bubble territory, meaning a lot of the corporate debt has been downgraded. A lot of bonds that people thought were safe, or I think leaning more towards the triple B minus and lower rated, meaning junk bonds. So I think, you know, there's a lot to talk about there. And, you know, I think the biggest thing that I would tell everybody is sit down and talk to a professional about it. Bonds are very, very complicated instruments. They're far more complicated than stocks, in my opinion. And really understand what you're investing in. I think that's the big thing. I think people should know what they're invested in. If you sit down with a financial advisor and he's like, don't worry about it, it's complicated, just do what I tell you to do, push back on that advisor. Your advisor should be able to very clearly tell you what you're invested in, and you should be able to understand that. One of the people that I look up to a lot, Peter Lynch, who managed Fidelity Magellan for many years and managed it very, very successfully, and has written numerous books, has said that if you can explain an investment to a 12-year-old child and have them understand it, then you shouldn't be invested in it. And I firmly believe that. So there's a lot of complicated financial planning products out there, a lot of this and a lot of that. And, you know, make sure that the financial advisor that you're working with, number one, is a fiduciary, meaning he has your best interest at heart. And number two, make sure that you as the client understand what it is that you're investing in. Don't just go ahead and sign on the dotted line because somebody told you to. And you know, everybody's an intelligent human being here. It's not that complicated. Somebody should be able to explain it to you in plain English, and you should be able to understand it.
Well, you know, it's not complicated to smart guys like you and Matthew, but but I think
what I'm saying is that the financial advisor should be able to put it into layman's terms so that you can understand it. Matt, would you agree with that?
No, yeah, Matthew?
Absolutely. Absolutely. It's got to be simple. And if the products underlying it may be complex, as long as you have an understanding of the principles, what you're getting for your money, most importantly, what fees you're paying on it, and the underlying expenses, it's important to know all that. But as Peter said, if it's not explainable to a 12-year-old, you should probably rethink it.
Well, that's great advice. And before, Colonel Kerrigan, are you still on the line?
I certainly am, Jack.
Outstanding, because we have another question actually we have two
Great.
questions, and I'm gonna combine them.
Okay.
As a question from Harvey, and Harvey asked, Mr. Kerrigan, can you give us an example of what premium costs are per year? And I'm going to tag on to the end of that question, when should I consider buying long-term care insurance? Because I think that should probably be part of your answer.
Great. Well, as far as the premiums, again, I'd recommend going to the website to take a look. It depends on so many different factors. But I would say, Jack, like anything else, it's always the idea that youth is wasted on the young. And I would just have the wisdom of doing it as early as possible. Interestingly enough, my mother-in-law, because my wife is serving in the Air National Guard, is eligible, but she's 85. It would not be economically feasible. So, again, I would recommend going to the website and then you can actually plug in your age and all the information. It's right there. And then I would do this as early as possible. But especially as you're about to get out of the service, it's that year that you're going to retire. My recommendation is to really look into this benefit. And just real briefly, so there's an individual here at the Air National Guard at Pease, and he's a family support officer. And he told me that when he got out of the service, he met with a financial advisor, probably someone like Matthew and Peter, and he went through all of his assets. And when he pulled out the FELTSIP program, he said this was one of the most valuable things he had. So, again, I'm not here necessarily, quote, selling this program at all. All I'm simply saying is when you're on active duty, and probably Matthew and Peter will agree, when you're on active duty, it's something you should consider doing, because financially, if you suddenly have to take care of your in-laws or parents, it can really damage you financially. And again, I'm certainly now working the reality of this with my mother-in-law and how we're going to do this, which actually means my wife has to continue serving in the Guard for many more years. So, again, it's a great asset to have, and my job, my calling, among other things, is just to tell individuals about it. Thank you.
Yeah, and so I don't know, Matthew, you're our financial planning guru here. Would you like to comment at all on long-term care insurance?
Yeah, long-term LTC is a very difficult thing. So long-term care prices and policy values and expenses are going to vary by state. So I'm in Princeton, New Jersey today, and long-term care policies in the state of New Jersey are very expensive. So like anything else, I would tell you to shop around because of the fact that you may get significantly different values depending on where you shop. Is anything, you get what you pay for, but not always in insurance policies. So when you're shopping, comparing policies, you need to make sure you're very detailed comparisons of what's included and what's not, what tier level facilities, ambulatory care, all these things are going to be detailed in the policy. So if you're comparing the price of one to the price of another, you need to make sure you very carefully pair apart the policies and learn what you're getting. So, a typical cost of a long-term care facility in New Jersey, where I am, between $12,000 and $20,000 a month. So to think of the insurance policy that underwrites that, you got to be very careful about what that insurance policy is and is not going to pay for when you're purchasing.
Yeah, that's pretty sound advice. Okay, we have a question from Nikki, who says that each of you, and I know she's talking about Matthew and Peter, commented on a volatile market. Should the market decline, what kind of mutual fund, or I guess investment, let's just talk about investments, apart from a lifecycle fund, would reduce loss of capital to enable one to take advantage of a future decline in the market? Maybe, I don't know. Anybody want to tackle that one?
Well, I just like to say one thing about market downturns. Market downturns are a good thing. They're not a bad thing. I know a lot of times people look at a market downturn as it's the end of the world and so on and so forth. But look at what happened this past March. The market dropped 35%, right? And the Dow Jones Industrial Average is 1% above where it was at the very beginning of the year. So it's pretty much back to normal. So if you're a long-term investor, what recently happened isn't that big of a deal. You should be back to where you were, if not better off, right? So that's number one. Number two, if you have a mutual fund or any type of an ETF or anything like that, you have to remember that there's different stocks inside that portfolio that pay dividends. Those dividends reinvest at a lower price point when the market drops. So it's actually a good thing for the market to drop, because you're reinvesting your dividends into that same stock at a much lower price point. It's on sale, in other words. So at the end of the day, when the market drops and your dividends are reinvesting, and then everything goes back to normal, you've actually made more money than had the market stayed the same or gone up. So I want everybody to not think of market downturns as bad things. And market downturns are very good for mutual funds, for ETFs, for portfolios in general. And they also allow the individual stock picker to go bargain hunting or buy stocks on sale. In every downturn, there's always different stocks or different groups of stocks or different asset classes that get beat up far more than they should. In 2011, when the U.S. debt rating got downgraded, all the banks took a dive, right? And it was a great opportunity to buy banks. Recently, a lot of stocks got beat up, and it was a great opportunity to buy a lot of good quality stocks. So, change your mindset a little bit in terms of thinking about market downturns. I love market downturns. They're great. And sometimes, if you're a long-term investor, don't do anything and just know the fact that your dividends are being reinvested at a lower price point, and you're going to make more money in the long run. So that's just what I would add to market downturns. I'm sorry. Go ahead, man.
Yeah.
I'll also add that if you have a systematic investment plan where you're contributing to your investments every month, as Peter mentioned, if there's a downturn, the market goes on sale. So those systematic investment contributions you're adding month over month, when the market's down, you're simply buying more than you would have while the market's at the top and its peak. And for as you mentioned, for long-term investors, you don't want to be worrying about you don't need to worry about upturns and downturns. I don't recommend for folks to open your statements more than once or twice or 3 times a quarter. For a lot of people, it causes a lot of stress. So be aware that ups and downturns are absolutely coming, and they're not the end of the world.
Well, it sounds to me like probably the biggest message is don't get skittish and freak out and sell everything. On the one hand, you don't necessarily want to throw your statements in the corner and forget about them. There may be some stuff you want to dump and some other stuff you want to get into. But what I'm hearing from you guys is don't be afraid of the downturns. And particularly, Matthew, from your comments, if you have a dollar cost averaging kind of strategy in place, and I see Peter shaking his head, yes, I should say, nodding his head, that you ride these things out, and if you're a conscientious investor, you're going to get ahead. That's what I'm hearing from both of you. So, well, let's see. Do we have any? So here's a question from Gordon. Can I withdraw my TSP from GS employment and reinvest it without paying taxes? So I think this is a question about transferring retirement plans. Peter.
If you withdraw, you're gonna be taxed, but you can transfer your TSP to an IRA tax-free. It's called an IRA rollover, and that has no tax consequences.
Okay.
Is that the question? Did I answer that correctly?
I think that's the answer, Matthew.
If he leaves the government, he goes in the private sector, can he transfer his TSP without taxes? Yes, he can transfer it to an IRA. It's called a direct rollover, and there will be no taxes on that. He won't be forced to pay taxes on it until the RMDs come up, which I guess has been moved to 72.5 now.
So obviously you won't be able to roll into a Roth IRA because there will be significant tax consequence on that. But as Peter mentioned, if you roll into a traditional IRA vehicle, you're able to do that. It's a great time to start a Roth IRA too.
Okay, great. Well, I think that question's answered. I'm looking, and I think we may have answered everybody's questions. So, does anybody have any parting words? Hunt, do you have anything for us that you'd like to stress?
Yeah, I'd like to stress something. Just looking back now after being retired now for 5 years, someone gave me the advice a long time ago: is stay in the service as long as you can. And I would highly recommend that. It's just such a great, wonderful experience. Thank you.
All right, Matthew.
Just thanks so much for coming. Be prepared for some volatility in the next 60 days in the markets. And just understand for those folks that are long-term investors, it's like waves on the ocean. They're going to go up, they're going to go down. But if you're a smart, systematic investor, paying attention to your fees and partnering with a good financial planner, you'll be in good shape.
All right, Peter, parting comments.
I want to thank everybody for allowing me to be a part of the warrant officers for, I guess, the last decade plus now. I've enjoyed every minute of it. I've gotten to meet many of you personally, and I've enjoyed every minute of it. The United States is the greatest country in the world, and it's the greatest country in the world because of our military. Thank you all, men and women, for everything that you do on a daily basis, everything that you've done. I know it's not always easy. I know there's a lot of sacrifices involved with being a part of the armed forces, but I just want you to know that I and my family appreciate you guys a great deal. Thank you so much.
Well, thank you to all of our panelists, all valued, wonderful partners of ours for years and years and years. And thank you for taking time out of your day to answer some of our questions and make us smart, especially in these uncertain times, and about financial planning. Thank you so much.
Thank you.